G'day, ladies and gentlemen. Welcome back to another video talking about Bitcoin. Today we have an interesting topic. It is the weekly chart death cross between the 50 and 200 week moving averages, which we've never actually seen before in the entire price history of Bitcoin. And so this has been cause for concern for people on crypto YouTube, for people on crypto Twitter, and of course for individual investors, because they're looking at this chart, this death cross that has never occurred before, and they're thinking, maybe the bottom isn't in. Maybe Bitcoin will go down further from here due to that death cross. Now, I disagree with that premise. I don't think the death cross is as important as people think it is. I'm going to be discussing that in this video extensively and debunking the argument that the death cross is massively cause for concern. We're also going to look into short-term price action and, of course, the interesting correlation between Bitcoin and the S&P 500 and traditional markets in general, and how that correlation is potentially declining, making room for Bitcoin to find that bottom at 15.4K and making room for Bitcoin to continue upwards over a long-term basis. Of course, we're not talking short-term here. And of course, bottom out as per the 4-year cycle theory intended. So let's get into it. Quite a few topics to cover, as I've just covered there. Before we get into it, pin comment, link below. We've got the VIP group, we've got Crypto Academy, we've got BitGet Exchange. Especially want to give a shout out to the VIP group. We've been doing some amazing work there, amazing trades, results released for Q4 a couple of weeks ago. If you're interested in checking out what the results were for the VIP group, you can do so. Again, pin comment, there's a link for that as well. So let's get into the video without further ado, guys. So just starting off with short-term price action, really not much has changed. We're still of the opinion that Bitcoin is not particularly in a strong position in the short term. That does not reflect long-term. Long-term, I'm of the opinion the Bitcoin bottom is in. I've held this opinion since around the 16K region. I wasn't too sure about it, that said, at around the 16K region, but I did say it was more likely than not. And now I'm of the opinion that it's very, very likely that the Bitcoin bottom was in at that 15.4K level and Bitcoin's bottomed out. So I do think that overall, the trend is going to be upwards. But I don't think that necessarily means we need to see a bull market, right? There's a difference between being bottomed and being in a bull market. We're not in a bull market. We're still in a bear market. This is something I've made myself very clear about. And I made myself very clear about the fact we're in a bear market until we break 28.6K. So to clarify, I think the bottom is in, but we're not in a bull market yet, okay? And we probably won't be for a sizable period of time. So don't expect massive moves to be upside. Obviously it's possible, but it just doesn't seem likely. Because at this point in time, we're following the 4-year cycle theory, and of course, the 4-year cycle theory doesn't necessarily suggest massive upwards moves just after the bottom. That's not generally what we see. On a macro scale, of course. So we know the short term. We've covered it quite a bit. Obviously, we had an ascending wedge formation, broke it for downside. We've came back up. We've seen a resistance support flip. It's pretty likely we continue downwards. And if we don't, we have the invalidation point at 22K. And we're looking to buy Bitcoin at around 19.5 to 19.8, and if we don't reach that region again, 22K will be the invalidation point for that kind of short-term analysis there. We've covered a lot of this in the past. We're not going to get too much into it today. If you want to look into that, you can check out my previous video I did yesterday. I looked into it quite extensively. But I just want to quickly point out, it's really great to see here with Bitcoin how it's not following traditional markets as much as it previously had. I know it's very short-term stuff, but it is great to see because, look, overall, the argument against the Bitcoin bottom being in is traditional markets going down and dragging Bitcoin down with it. And we've seen in the last 3 days here, Bitcoin maintaining steady, maintaining level, while the S&P 500 has 3 red candles in a row. And strong red candles at that, red candles that have taken it back to the point of December 22nd. So S&P, by the way, is retraced to a point in which it hasn't seen since December 22nd. Bitcoin on December 22nd was all the way down here at 16K, and we're still up at 21K. So it's really great to see that deviation start to happen, and we have evidence of that as well. We have the Bitcoin correlation with the US dollar downtrending over time since August 2022, which is very reassuring. So I think at this point in time, the 4-year cycle theory and the 4-year cycle theory's prediction of the bottom there in Q4 was excellent, and I think it's being supported by the downtrending correlation between Bitcoin and the traditional market. So it's great to see. I think the bottom is in. I think there's adequate reason to believe that at this point in time. And we're going to be looking at that correlation between the S&P and Bitcoin quite extensively over the next few months to make sure it's still downtrending. If it does turn out that Bitcoin is going to be dragged down by traditional markets, we could be in for a rough ride. But at this point in time, that doesn't necessarily look like it will be the case. I want to make a point as well. Bitcoin will always be connected at least slightly to the macro. It's just how it works. If people have less money, Bitcoin's not going to go up as much, right? It's just simple as that, right? Because it's people's financial situations. They don't have enough money, they have more debt, etc. They're not going to be able to invest as much in crypto, so it kind of always will be connected. But it's not necessarily about it being connected or linked. It's about the extent of the connection, right? If the S&P drops down sizably, okay, S&P's dropped down to levels it hasn't seen since December 22nd, Bitcoin not even close to that. We've still dropped down a little bit, right? There still is a link there. There's still a link between the S&P and Bitcoin, but it's not as strong as it was. And it's great to see that. I really can't stress that enough. So that's the first component of the video I want to talk about. And I don't want to get too much into short term. Don't want to get too much into all of that because that's definitely a topic for a future video. There is a case to be made that Bitcoin could be seeing quite extensive upwards price action, even with the S&P going down due to people shifting out of traditional markets, realizing it's in a bear market and shifting into crypto. So that's an interesting argument in itself. And again, we'll cover all that in the next video, but really want to talk about today is the DevCross. I want to briefly interrupt this video to talk about the BitGet exchange. The BitGet exchange has 5 times lower fees than Binance on futures. It has 0 spot fees for spot trading, meaning you can trade spot for entirely free on every single coin. It has a rewards center. It has a protection fund. It has events regularly run. For example, the FIFA World Cup event it ran recently was in partnership with Messi, the famous football player. There are many, many reasons to sign up using this exchange here, but if you sign up using my exclusive referral link, which you can find a link to in the pinned comment or description, you will get a further 15% decrease on futures fees, and you'll get access to an exclusive reward center in which you can gain access to 4,000 USD in rewards via completing various tasks of various difficulties. Signing up to this exchange using my referral link is by far the best way you can support the channel, and it's the best way you can support yourself as a trader, gaining access to the cheapest exchange on the cryptocurrency market. Now, for my viewers from the United States of America, when you're signing up to the exchange, click on Other as Country of Residence, as you can see I'm doing on the screen now, and you will be able to sign up and use the exchange normally as a non-KYC customer. You'll be treated exactly the same as everyone else in the exchange. So please sign up using my referral link. Thanks for watching the advertisement. Let's get back into the video. Because this is probably the biggest concern that people are having right now outside of the traditional markets in terms of TA itself. The TA has been pretty strong recently. We know this. We've broken above major levels. We've held the uptrend. We've held the 8-year uptrending support line, broken bull market support band, broken 300-week SMA, broken 200-day SMA, broken heaps of things to the upside, broken horizontal levels, right? We're doing really, really well for Bitcoin, but the one kind of nail in the shin, nail in the side. What is that saying? I can't remember. But the one kind of bad thing that's happening really that a lot of people are looking at is the DevCross and the weekly chart. And I want to take a moment just to discredit this and debunk it. I don't think it's a big concern. Okay. And DevCrosses, of course, are bearish indicators. They are bearish indicators. It's where the 50, right? The red line, the 50 MA crosses under the green line. The green line here is for 200 week, moving average. And the whole premise around what a DevCross is when that cross happens, you're meant to see a dump, right? You're meant to see the price action go down. And this is not incorrect because we've seen it before. We've seen it on the 3-day chart, for example, okay? So these are the same indicators on the 3-day chart on a different time frame. We see that when that happened here, the red line crossed under the green line. We saw a massive drop on Bitcoin 2018. Same thing here in just last year, actually in May 2022. Red line crossed under the green line, massive drop there as well. So DevCrosses are bearish indicators and they do need to be watched out for sure. And that's why people are concerned about the weekly chart DevCross, because obviously the higher the time frame, the more dramatic the impact is to a certain extent. And so this weekly DevCross is very threatening. So the whole premise, the whole idea is that when this cross occurs, which is inevitable at this point, we cannot avoid it. When this occurs, which, could be, let's just take a rough estimate here. It realistically could be any time in late January, early February, somewhere around there. When that occurs, the argument that the bears are having is Bitcoin's going to dump. I categorically disagree. Why? Let me get into it. DevCrosses are not actual things. DevCrosses, right? Crosses on moving averages don't actually mean anything. They are merely a representation of price action. Okay, it's very important to note. Moving averages, they're not actually support and resistance levels. They're representations of price action that people utilize as support and resistance levels because they buy near them and sell at them when they're going upwards, right? These lines crossing doesn't actually mean anything. It's not actually an indicator. It's not a breakout in the same way that a market pattern like a triangle or a wedge or a channel is a breakout. What we'll notice as well is that these lines have to cross each other eventually due to diminishing returns. There's simply no other way around it. If we are seeing Bitcoin gradually round out on a macro scale, we're going to see naturally these lines come closer and closer together as volatility rounds out as well, as volatility comes to a stop as well. So these lines were inevitable. They're going to have to cross at some point. Does that mean we're going to see a dump? I don't think so. Let me tell you why. As I said, they are a reflection of price action. They are a representation of data. They are not unique indicators. They occur due to the way the market is moving. So what you'll see here is that even in this chart, even in the Bitcoin chart and the 3-day chart, we saw these market patterns. We saw a descending triangle formation. And yes, we saw a def cross. And yes, the def cross happened to occur at the same time we saw a dump. But the dump didn't occur because of a def cross. It occurred because we broke out of a market pattern that already existed. Okay, same thing over here. Yeah, we saw a def cross, okay? But the def cross didn't occur. The def cross didn't lead to the downwards price action. The downwards price action was the result of a market pattern that already existed on the charts breaking to the downside. As I said, it is merely a representation of price action. It does not actually trigger unique price action generally. Okay, so the point I'm making is this. It's not that the def cross is completely irrelevant. You should never look at it. It's not bearish. Of course it's bearish, but the point is it's not as bearish as people think it is. There are always other factors that are more important. For example, on the 3-day chart, the triangle was more important. On the 3-day chart as well in 2022, the wedge here, the bear flag formation was more important. Right now, we don't have any bearish structure forming. There is no bullish structure forming here like there was on the 3-day chart to back this def cross up, right? We don't have a bearish structure forming. In fact, what we have, to be honest, is kind of like a bullish wedge forming, right? If we went to the linear chart, we can see this play out quite nicely. We actually have a bullish descending wedge formation forming. And so this def cross, the big question is, well, is this def cross that is inevitable to happen due to diminishing returns, that would have happened regardless of what's going on with Bitcoin, is this def cross going to lead to downwards price action, or is this massive bullish descending wedge formation going to lead to upwards price action? And the answer is simply, we cannot know. We don't know the answer to it. But I would be inclined to believe that even if we see the weekly def cross, right, and even if we see downwards price action due to the weekly def cross, it's not going to lead to this catastrophic drop that people expect, because when you have an indicator on a weekly chart, okay, by the time that indicator plays out and has been playing out for a few weeks, people run into new reasons to buy or sell. You have to remember, the price moves up or down because people are buying or selling. They buy and sell based on reasons they see in the charts and in the news, but mainly in the charts. So this is the problem I've always had with massive charting patterns on weekly charts, for example. By the time that pattern has been playing out for a few weeks, people have moved their attention to another pattern to react to. So the effect of a def cross on the weekly chart, yes, it may occur and it may lead to downwards price action, but ultimately it will be forgotten within a few weeks. And ultimately it is just a representation of existing price action that would have had to exist due to the bear market. It's very important to note, this bear market hasn't been particularly violent in comparison to previous bear markets. There has been a 77% drop. In 2018, there was 84. In 2015, there was 86, okay? If this was truly a once-in-a-lifetime def cross and it was so unique, it would, the fact that it's occurring on a relatively tame bear market is reassuring, because it's reassuring us of the fact that the def cross isn't occurring because the market's particularly bad. It's occurring because it has to, based on diminishing returns. So that is my argument about the def cross. I don't think it's particularly important. I will be looking into it, of course. It could very well lead to a drop, but even if it does, I don't think that drop will be volatile enough to drag us out of the 4-year cycle theory, which is a 10-year-long macro trend on Bitcoin, much stronger than a def cross on the weekly chart. So that's my opinion on that. So without further ado, I'll end the video there. I do want to quickly take a look at the Crypto Academy exchange. If you want to learn how to do a TA like I do, and you want to learn all about def crosses and moving averages and obviously other things as well, in fact, every single thing that I use in the charts, you can check out the Become a Trader 10-unit course. We have 10 units going from step 1, literally the basics, all the way through to advanced things like risk management, how to find trades. We go through technical indicators, market patterns, candlestick formations, market psychology, the whole 9 yards on this course here. You can check out the course information on the website in the pinned comment or description below, and ultimately you can throw us an email at cryptoacademycourses@gmail.com for free, and we'll get back to you with a full pamphlet of the information of the course. So thanks for watching, guys. I've got an important video coming tomorrow on the traditional markets and its relation to Bitcoin. I'm excited for it. Thanks for watching, and I'll catch you guys in the next one. Cheers.